Welcome to the Real Estate Investing Morning Show with your hosts, Wayne and Gabby.
Hey, good morning.
Good morning, real estate investors. Oh, we got a show for you guys today. Today, I'm actually heading out. I'm going to be touring in Edmonton with my realtor. I'm going to be looking at 9 properties today. I'm going to be touring 9 properties, and I'm planning on buying a bunch. And I'm thinking that for today, how about I share all of those properties with you, all of the addresses, and exactly why I want to buy these properties.
What? You wouldn't do that. You might get competition. You're not serious, are you?
No, I'm not going to.
Okay.
Why would I do that? I haven't even run an offer yet. No, I'm not going to do that. But you sure would love that, wouldn't you? You sure would love that.
I think they would.
And I think that they would love that because they want to know what we think is a good deal.
Yeah.
They want to know what's going on in our mind right now. What if I had some money and I could invest it, I sure would love to buy exactly what Wayne and Gabby are buying, right?
Yes.
But, it's one thing to give you the addresses of the properties I'm going to look at today. But what I like to do is I don't want to give you the answer. I want to show you how to get the answer for yourself.
Mm-hmm.
So for today, what I'd like to do is I'd like to show you, how could I word this? What I want more so is to show you exactly what a good deal is and how to figure out what a good deal is. Okay? So I know exactly what I'm looking for because there's key metrics that I measure a good deal by, right? And there's lots of them, and I can't go over all of them today. But if you understand those metrics and you understand real estate investing opportunities and trends, you'll be able to get really, really good deals. Mm-hmm. And so for today, what I'd like to do is I'd like to focus on one of those key metrics that I use. I think it's the most important. It's going to shock you because most people think the most important metric that you should be following is cash flow. Mm. Everybody thinks that cash flow is the most important thing, and it is. It is. Cash flow, and you've heard me say this a million times, is a measurement of risk. The more cash flow you have, the less risk you have. But do you really want to buy a super, super safe property that's not profitable?
Mm. Okay.
Or do you really want to, why are we investing in the first place? We're investing to make money.
Yes.
So actually, we want to make the most money possible. The absolute most money we possibly can. And we want it to be safe. Because investing is, there are no guarantees in investing. But if we were going to invest, I want to make the most amount of money possible. I also don't want to lose all of it. Mm-hmm. Right? So we were talking yesterday, and so one of the questions that came in late yesterday, or the last question we answered yesterday, was all about, I'm a little bit later in life. I think it was like I'm close to retirement. Yeah. And we were talking about, you don't really have a whole lot of time to play with. Time is another, risk mitigator. The more time you have, the more the more aggressive you can be. Yeah. But when you've only got a little bit of time, you're going to have to dial up if you want to hit that target, you don't have the luxury of dragging it out. Mm-hmm. So that's what kind of led me into today. And that is that, ultimately at the end of the day, obviously most people think cash flow is really, really important, but I really want to talk about something else, another metric that I find the most important, which is talking about your profit. And how do we measure profit? Well, we have to measure it relative to the amount of money that we put in. Mm. Okay. You could say, yes, I made $100,000, but if you had to invest $50 million to make $100,000, is it a really good return?
That's true. It's not.
What if you invested $10,000 and made $100,000? Would that be a really good return? Mm-hmm. See? So it's relative to the amount of money that you're putting in. So if the profitability is to know how good the profit is, you have to know how much you put in to get that, then there's a very simple calculation that we're going to be going through. It's called return on investment. That's what we're going to be focusing on today. If you understand how to calculate return on investment and you understand how to run those numbers very quickly, it will help you compare all properties, apples to apples, very fast. And you'll be able to know is the deal that I'm looking at good compared to all of the other real estate deals that are available on the market?
Right.
So that's what we're going to be covering today.
Okay. And we also, I don't know if, is Rich with Rich here today?
Rich?
Rich with Rich? Hey, that's actually kind of hard to say. Rich with Rich. Anyways, we had a leftover question from yesterday's live that it was about garden suites. So I would like to get that question answered before we get into our discussion on return on investment, if that's okay.
What did you say his name was? Rich Boy Rich?
Rich with Rich.
Is it Rich with Rich? I thought it was Rich for Rich.
Rich by Rich?
Rich man Rich?
Richie
Run,
Rich?
Rich.
Richie
Run,
Rich.
Rich, run. Rich, run, run.
By the
You
way,
sure?
who are you, Rich with Rich? Yeah, I think he normally joins a little bit.
Is he rich?
I think his name must be Richard. It has to be, right?
Dick Rich.
Okay, calm down.
Rich with Dick? Oh, I'm
No,
sorry.
stop.
What?
Why
It's
are you
a
keeping
short
on
form.
going? I have this one eye that's leaking really bad. I wish I had a tissue.
Stay
right
on
now.
topic, Gabby. That's the worst
Oh my gosh.
topic change I've ever seen in my life.
Sorry,
Oh my God.
I need to get
something in my eye.
I'm actually crying if you can see up close and personal.
Because I'm so funny?
Yeah, we'll go with that. Anyways, do you think we could answer a garden suite question before we dive in? Is that okay?
Mm-hmm.
Mm-hmm. Yeah, sure.
Oh, this thing's leaking today, but gosh golly, it's a good coffee. How's your coffee today, guys? You guys joining us live? Or are you not live? Where are you? Are you here live with us on YouTube this morning? Let us know in the chat. Say, I'm here, I'm live, I'm alive. I'm rich. But are you rich?
Kirsten's here with us. Carmen.
Nice.
Hello-
Good
hello,
morning,
ladies.
guys. Good morning, yes.
Francis is here. Yeah.
All right.
And Kyla.
Let's go.
And Mayatoma. I'll never be able to remember their real name. Maria?
Yes, thank you.
It just came to me last minute.
Um,
I'm just going to read what's in front of me.
Don't call my name. Don't call my name. Mayatoma.
Every day. It's going to happen every day. Good morning.
Okay, so we're broadcasting live on YouTube like we do every weekday morning at 7 a.m. Mountain Time. Yes, if you're listening to the show on Spotify or YouTube or wherever, Apple Podcasts, and you just kind of stumbled upon this, this is broadcasted live and you can join live. And it's at a reasonable hour. It's at 7 a.m. Mountain Time every weekday morning. It is your drive time morning show for real estate investors. And where was I going with that? Gosh, this sure is live, isn't it? Anyways, you can join us as well. All you have to do is just, download the app YouTube. That's pretty simple. And just search up the Canadian Real Estate Investing Morning Show or Wayne Hillier, Real Estate Investing Coach. And you can come and join us. You can be a part of the conversation. If you have anything to add, feel free to put it in the chat there. Let us know. Let us know what you're up to, what you're interested in, anything. If you have any, thoughts about, today's topic or questions, any questions at all. Actually, we will answer any of your questions for free.
Mm-hmm.
We provide free coaching for real estate investors every weekday morning. Every day we wake up early. We do this show so that we can provide you with whatever you need for whatever you need to do today. So if you are working on getting your first joint venture partner, you're trying to raise some money for your first deal, put your questions in the chat. Whatever's preventing you from doing it. If you are struggling with running the numbers on your deal, put the information in the chat. We'll run through it. Anything we can do to help you guys in order to get you to take action today.
Mm-hmm.
Because if you just sit here listening to the show, listen to my dick jokes, listening to all the dumb stuff that we do, or even the good stuff, you just keep on listening to the good stuff we keep talking about every day. Like all these amazing opportunities and all these things that we're doing and other people are doing. And you're just here sitting listening. Like, what are you doing? You're just wasting time. Every day you're wasting another day. Another day. Another day. Another day. And one day you're going to get close to retirement age. And you're like, oh, shoot. I really, really should have planned a little bit better. Maybe I really, really should have made some notes or asked some questions while I was listening to that show all those days. And maybe I should have done something. Mm. Maybe I should have set myself on a different course. But now here I am stuck. And now I got to figure out how to do this. And now Wayne's telling me it's going to be risky because I'm running out of time. Right? So anything we can do to help you guys. We are the only free coaching in Canada, and we do it every single morning.
Yeah.
So take advantage of it. Okay?
It's here now. It won't be forever.
Yeah, one day we just won't be here. And I'm going to laugh so hard.
No, you won't.
I will.
Okay.
I will. I'm going to laugh so hard because I'm going to be like, there's somebody out there being like, fuck.
Dang it.
Dang it. Why didn't I? If you can't make it in live to the show, that's completely fine. We get it. You got kids. You got a job. You start work early. You stayed up late. I don't know, whatever. There's obligations.
They're in a safety meeting. That seems to be like the most popular.
They're doing
the safety meeting starts.
They're doing the safety stretch. But anyways, doesn't really matter. I get it. Life gets in the way, and everybody's got responsibilities. If you can't join us to ask your questions, you can email them in. Email them in to info@reimorningshow.com. Send your question. We'll read it for you. We read a bunch of questions yesterday on yesterday's show.
We did, yeah.
Alrighty.
Kirsten, don't encourage Wayne's
See, Kirsten
Richard
has
jokes.
lots of really, really, really good things to add in the chat here. And I'm not going to read it because Gabby wants me to move on. Because Richard had a question yesterday.
Yes. Okay. We're going to answer that right now.
Sure.
Okay.
Yes.
So Rich with Rich asked, what's the difference between a multi-unit garden suite and a fourplex?
Oh, okay. They're both the same. Well, sorry. Hang on a second. I use the term multi-unit garden suite because when you say garden suite, people automatically think a garage suite, right? And because that's the most common form of a garden suite. Then some people think that a garden suite is ground level garden suite, meaning that it's like it's in around there's a garden around it, and it's a ground level cute little suite that Grammy lives in. Okay, and it's 400 square feet, just a little.
Which is also true.
Which is also true. That's also a garden suite. So a garden suite is the new term because there's different variations happening now. One above a garage, one ground level, right? Yeah. So we use the term garden suite, but a lot of people, when we say we're building a garden suite or garden suites, they just think that it's individual garden suites, whether it be an individual ground level or an individual above garage. We're not doing that. What the term multi-unit garden suite refers to garden suites with multiple units in it, not just one. So that could be a side-by-side, like a duplex garden suite, or what we're building in Edmonton. And by the way, these are the first in Canada. Nobody has ever done this in Canada before. We are building the first ones, which is a 4-unit garden suite, which is 2 on the ground level and 2 above. And so that is technically a fourplex. So I'm building a fourplex in the backyard.
Yeah.
And multi-unit garden suite just seems like the most clearest way to explain it to everybody.
Well, also, Wayne, when we're talking about garden suites, the real definition of this is that it is a backyard. And so originally it's called a garden suite because it's in the backyard where you'd find a garden, right?
Yeah.
So other terms you might hear is a backyard garden suite. Yeah. It's referring to it being on site of a regular dwelling, but in the backyard. So it's not like we're removing a house and putting it where that regular structure would be. True, yeah. That would be your standard fourplex on the property. This is in addition to and in the backyard. Yeah. Right. So if that helps also kind of like define those two.
Yeah. So it's in the back. We're not touching the original structure, the existing structure at all. The house in the front is staying. I mean, we could do renovations on it, but we're not tearing it down in order to build a fourplex in the front with basement suites or something like that. Yeah. We are leaving the house in the front and we are developing in the back. Mm-hmm. So we're doing infill development in the back, which is providing tremendous opportunities. And the reason, I don't want to get too far into this, but I've talked about this quite a few times. If you go back just a couple weeks ago, there's tons of episodes on it, and we'll talk more about it. Yeah. But the big opportunity was because the market was getting oversaturated with the same type of a product being that people were tearing down houses and building 4-row houses or 3-row houses with basement suites and building their quote-unquote 4-plex, 6-plex, 8-plex. But it became so incredibly oversaturated that the values of the properties went too high, and the cost to build was too high, and the numbers didn't make any sense, right? I mean, they did make sense for like a small period of time in like 2023, until 2024, they changed the zoning rules, and then it didn't make sense anymore. Oversaturated the market. Now the rents are all down, and the numbers just don't work. And I saw that from a mile away. Anybody with any real estate investing experience or half a brain a decent foresight should be able to know that. But I mean, it is what it is, and now we're seeing what we're seeing. Hey, stay tuned to next year when all those renewals come up.
They're starting. Renewals. It's starting. Yeah.
Stay tuned when all those mortgage renewals come up, but that's a different topic. When I realized that, I was like, okay, well, what other opportunities are there available? And I looked at all of the properties that are large enough, but the house is perfectly fine. That was the aha moment for me, was that like there's a perfectly good house. And I was so tired of seeing people tearing down perfectly good houses.
Yeah.
What are you doing? Actually, I drove through a neighborhood yesterday, off topic, but drove through a neighborhood yesterday. I'm like, what the fuck? I was just here 6 months ago. And that house is perfectly fine.
Yeah.
Actually, it was
good
for
bones,
sale.
Good bones, all of them.
It was for sale a few years ago. Like, I know that it had good bones, okay? So, like, anyways, and they're tearing it down to build. So I really didn't like that. But I was thinking about it. I'm like, there's so many houses out there that, like, are a little out of that price range. You know what I mean? That people would normally buy to tear it down and do the whole thing. And I'm like, what about the houses that are perfectly fine, a little bit outside of that price range? But could we build in the back and create value, and where the numbers work? So that's where it all kind of started. And then we were able to develop this new strategy that investors can use in Edmonton, only in Edmonton. Well, you can do it in other cities, but there's a lot of, I'll teach you all about it just another day. Yeah, that's where it all kind of came from. So we're building, personally building 4-plexes in the backyard garden suite 4-plexes. Hopefully that answers your question. Yeah. If you want to come and see one, come on out on August 22nd. We're holding an Edmonton Real Estate Investing Bus Tour hosted by ROI Masters. And you can come out and actually see one of our development projects. It's under construction right now. It will probably be past the paint stage at that time. I think the one we're going to be showing. So you'll be able to see it. We'll be able to walk you through all the numbers and everything else, why we chose that property and what it's going to look like. So if you want to see that and you want to learn about doing that yourself, all you need to do is just come to the Edmonton Real Estate Investing Bus Tour hosted by REI Masters, August 22nd. You can get your tickets at www.reimasters.ca. One of the big, determining factors on whether we were going to do these types of projects or not. When we were looking at it, we were trying to find the next big opportunity for investors in Canada. One of the metrics that I was looking at was return on investment. That's very important. We were also looking at cash flow as well, but return on investment was that's, like I said, arguably the most important to me, because I want to know the money that we put in, how much money is coming back, right? How much money is coming back relative to the amount of money that we put in. That is the most important thing. And then you want to ask yourself, how can I make this as safe as possible? This is a great return on investment, but how risky is it? Mm-hmm. And there's tons of great investments you can make out there that are going to get you great returns or potentially great returns. But how risky is it that you're not going to make those returns, or you're going to lose all your original money, right? Mm-hmm. So for return on investment, I really want to talk about that today, and we're going to talk about how to calculate it, and we'll be diving into that in just one moment. We're going to take a quick little commercial break.
Real estate investors need to treat debt differently than homeowners, and at Kirkland & Brennan Mortgage Group, we understand that. For the last 11 years, we've helped real estate investors plan and build their portfolios. We understand how to help you avoid fees, penalties, getting yourself stuck, and making sure that the deal you're doing today doesn't stop the deal you want to do tomorrow. You can reach out to Keaton, Keaton, at kbmortgages.ca. Put plan in the subject line, and we'll help you build a plan and then realize it for your real estate goals. We also coordinate with the other professionals like your accountant, lawyer, realtor, and we will help you build your portfolio. So reach out. We'll do our best to help. Thanks, guys.
You've got showings, lease signings, suite renos, condo board meetings, credit checks, mortgage financing, and every so often the tenant clogs the sink because they shoved macaroni down there. Stop. Breathe. Leave the bookkeeping to Fingo. Fingo is specialized real estate bookkeeping by real estate investors with tailored services for maximum returns. Save time. Enhance your returns. Claim the plumbing repair for that ridiculous macaroni fiasco. Book your free consultation at fingo.com.
Summer. While everyone's getting distracted, this is when the market gets quiet. Not because the opportunities disappear, but because the people do. Vacations, long weekends, these are the distractions I'm talking about. And that's exactly when serious investors make their moves. At Calvin Realty, this is one of our favorite windows. Less competition, more flexibility, and sellers who are actually open to negotiating. While everyone else is stepping away, we're stepping in. If you're looking to buy right, not just buy fast, this is your edge. Calvin Realty. Opportunity doesn't take time off.
Alrighty. Full transparency, guys. We talk about this a lot. We do not prep.
Do not.
What?
You kind of had a little drawl there.
We do not?
Yeah, we do not. Sorry, go ahead. Just poking fun. Apologies. Continue. Now you're going to roast me next time.
Bullying is not acceptable anywhere.
I think it is between husband and wife.
As I was saying, we do not prep this show ever. This is a live show. We've done it every weekday morning at 7 a.m. for I don't know how many years. We're must be over 1,300 episodes now. We've never prepped a show ever. So normally we just kind of go off of questions. But today's show, because we didn't have any questions, I decided to put this episode together about 4 minutes before the show started. So frantically, just kind of writing down some notes because, I mean, most days I can kind of put this stuff together, it's not that difficult. This is stuff that we teach every single day, every single week to our students. This is stuff that we use in our own business. I've done this a million times. And then our students ask us questions about this, and we teach this to our students every single week as well. We've taught hundreds of real estate investors across Canada. But for some reason this morning, I'm just like, oh crap! Like I know what I want to teach, but I just didn't get my what do the teachers call it? Dennis, you're here. Is it like a syllabus? Syllabus, is that the right word? What's my teaching syllabus for the day? Somebody help me out. He's here, isn't he? Somebody answer me. Syllabus? Is that what it is?
I don't know.
As an outline or list of topics, readings, or assignments. Okay, yeah, it's a syllabus. It's a syllabus for the day.
Nice. Nicely done.
I used a big word. Anyway, so let's start off by, as I mentioned, to recap, if you want to know if you've got a good real estate deal, you want to know how profitable is it, okay? Just like any other form of investment, if you were to buy something, you want to know, hey, I'm going to put $100,000 in. How much money am I getting back? Mm-hmm. And you can calculate that over however long you want. You know what I mean? Like you want to, if I could make $50,000 on that $100,000 investment, that's a pretty decent return, right? And I'll talk about how to figure out that percentage in a second. But that's a pretty decent return. But it would be amazing if I put $100,000 in and I got $50,000 back in one day. Wouldn't that be fucking dope? 100 in, 50 back, same day.
Oh yeah.
But what if I put 100 in and I got 50 back over 30 years? Is that still good? See what I mean?
Really.
This is where it's really, really important, is that, like, how do you compare different investments?
Yeah.
Not just different real estate deals, but different investments altogether. People talk all about, like, oh, I made this much money. I'm like, okay, cool. How much did you put in and how long did it take?
Right.
Right?
Yeah.
That's how you should be measuring it. And then if you understand how to measure that, then you can compare not just one real estate deal to the other deal, but you can compare real estate to, investing in gold, to investing in, some business that you're really interested in, or into crypto, whichever else. You can go right across the board. It's universal, and you can figure out which one is better.
Yeah.
And here's the deal. Return on investment, though it's a very, very simple formula, is almost fucking non-existent in discussions and conversations in this community. Nobody talks about it.
Okay.
And the people that do talk about it they calculate it so fucking wrong and so loosely that it's very hard to watch. It's very hard to watch. But ultimately, at the end of the day, I think the reason why people don't talk about ROI so much is because everybody is so hard for cash flow, which again, I'm all for cash flow as well. But I'm all for cash flow because I want low risk. But there's nothing worse than buying a super, super low risk investment that actually didn't make you very much. I'm putting my money in to make money. Yeah. That's why ROI, the return on investment, is so incredibly important.
Well, is it fair to say also that people either don't really understand how to calculate profit in the first place, or when they're doing it, it's super inflated profit based on
that's
crazy.
What I meant.
Yeah. Okay.
That's what I meant. When people do, they'll use their realtor's pro forma that has super inflated numbers, which I'm going to talk a little bit about that today too, on how to accurately calculate your return on investment.
Yeah. Yeah, because I think that's where probably a lot of people go wrong, or where a lot of people end up, maybe they get investors in on it or whatever, or they get into a deal on their own. And then a few years later, they're like, this isn't what I was expecting, or I'm sorry, we didn't make what we were expecting to make, or
because they went off of their realtor's projections.
This happened. So, and it's where all of a sudden none of it made sense in the first place.
And I'm going to talk about the difference between projections and actuals as well. This is one of those other things that I wanted to write down. So these are things that I teach all the time, but I'm just like looking at the clock and I'm like, how much time do I have here? So this is something we've taught to our students many, many, many times about the difference between projections and actuals, because you can run your return on investment calculation to determine how profitable it is. But most people run it based off of projections that they get from their realtor. Yeah. So they'll say, look, this is the return on investment that we're going to get. And I'll look at it and I'm like, this is all based off of hopes and dreams, right? So we're going to focus on actuals for the most part in our projections. And then we'll be hopeful that,
that maybe it might be better.
That it might be better. And that's what I like to do when I'm pitching deals, or when I'm analyzing deals, but also when I'm pitching deals, is I don't like to be too conservative, because sometimes that might be a bad thing as well. But I'm just going to focus on the actuals that I know. And then I'm going to be hopeful that the real estate and the rents and everything else will go up more. But I don't have any guarantees of that. Yeah. But first, let's talk about how to calculate return on investment. And this is super, super simple. Okay. What you're going to do to calculate return on investment is you're going to take your total profit over whatever period of time, your total profit, and then divide it by your original investment. Okay. So let's start off with the original investment and what that means. If this were any other, if you were buying crypto, how much money did you put in? And then how much money did you get? How much money you put in would be your original investment. Okay. Yeah. The profit would be how much money you got back minus your original investment. Okay. So, but with crypto, it would be like, how much money did you put in? I put $100,000 in, I got $150,000 back. Okay. With real estate, it's just a little bit different, because you do put money in originally, and that would normally be your down payment, right? You're 20% down or you're 25% down. But then again, you also have a few other things that you would normally put in as well. Closing costs, lawyer costs, those things. So your original investment would be whatever your upfront costs were originally. And so I would say down payment, your reserve fund, initial reserve fund, and then maybe lawyer fees and home inspection. Okay. Yep. So tally all that up, total it up, and write down what your original investment was. Okay. And that's that. Now your profit, how do you figure out what your profit is? And I said, depending on how long of a period, you know what I mean? Let's assume that we're not going to do projections. We're going to do actuals. So let's assume that you bought a property and you put $100,000 down. So you bought a $500,000 property. Okay. And then over a period of, say, 10 years, you made $200,000. Okay. How did I come to find out what that $200,000 is? Because most people would think that like, okay, I bought a $500,000 house and I sold it for $700,000. There's my profit, $200,000. Yes, but there's other profits as well that you need to calculate. So we're going to ignore that $200,000 there for a second. Let's say the total profit is $400,000. I'm going to say the total profit is $400,000, okay? Just for easy math. How did I come to that number? Well, there is appreciation. So we bought it for $500 and it went up to $700. So that means that we have $200,000 worth of appreciation. So on your paper, I want you to write next to appreciation or value increase, we're going to put $200,000. So the difference between what you bought it for and what you sold it for, okay? Then you have other profit centers that you need to add up. And the other one is on Gabby's sweater, cash flow. So what you're going to do also is take your total cash flow for those 10 years. All the monthly cash flow that you made, okay? So the difference between your rent and your fixed expenses, and variable expenses, whatever, throughout the year, take all of your cash flow and add that up as well, okay? For simplicity, I'm trying to keep this simple because I know it's going to be complicated because there were also a bunch of expenses. So just imagine you don't spend any of your cash flow. You take all of your monthly cash flow every month and you put it into your reserve fund, your bank accounts. But then throughout that 10 years, you probably fixed a dishwasher, replaced a fridge, et cetera, et cetera, et cetera.
Yeah.
So at the very end, what I want you to do is I want you to look and see how much is in that bank account after 10 years, not including your original reserve fund money, okay? So at the end of all of it, after you paid all of your fixed expenses, which are like your mortgage and your property taxes and your insurance, and then after you paid all of your variable expenses as well, like furnace cleanings and furnace filters and gutter cleaning, you have your vacancies, you have your dishwasher repairs and everything else. At the very end of the 10 years, there's $50,000 in that bank account. That's how much net cash flow you made. So we're going to put $50,000 down as well. Okay, so we have $200,000 in profit for appreciation, and we have $50,000 in total cash flow. Then the other profit center that we forgot about was that every month that you've been making those mortgage payments, your original mortgage of $400,000 has been going down because a portion of your mortgage payments is going towards the interest, and a portion of your mortgage payment is going towards paying down the balance of the loan, the mortgage. So every month you're making a mortgage payment, it's going like this over and over and over again. And that gap between where it started at 400 and where it ended 10 years later is equity as well. That's profits. So how much in mortgage pay down did you have as well? Okay. So in that case, let's assume for simplicity, $150,000 of mortgage pay down. So how did I come to that $400,000 profit originally? I looked at how much the property went up in value. I looked at how much the mortgage balance went down to, how much equity I created through mortgage paydown, and how much total cash flow did I have net after we paid all of our expenses. Okay? That total was $400,000. All right? And what you're going to do is you're going to take, to calculate what your return on investment is, you're going to take your total profit, which is $400,000, and your original investment, which is $100,000. I should have done this beforehand. Take your profit, divide it by your original investment, and that number comes to 400%. That's an easy number. I should have known that. Sorry. Apologies. I'm looking at all my other notes ahead. Yeah. That's a 400% return on investment. Okay?
Over 10 years.
Over 10 years. If you want to figure out what that is per year, just take that 400% and then divide it by 10 years, and you would get an average annualized ROI of 40%, which is phenomenal.
Yeah, so good.
Phenomenal. Now, these are just, hypothetical rough numbers here that I just put together. But that's not an unrealistic number for the deals that we're doing.
For sure.
Not at all. Right? And I think those are quite reasonable numbers. So that's how you figure it out. Okay. So now if you want to know how well did this property do compared to my other property, so let's say you bought 2 properties 10 years ago at the same day, and then you sold them both on the same day 10 years later, what you can do is you can take all of the appreciation, all the mortgage pay down, and all of the total net cash flow and determine which property did better. That's how you would figure it out. Whichever one had a higher return on investment percentage. Does that make sense?
Yeah. So
very super simple.
It is simple. And you're talking right now about actualized profit and return on investment. So I'm sure that people are wondering, how do we determine that ahead of time to make sure that we invest in a good deal with high return on investment?
Absolutely.
Which I'm sure you're getting to.
Yeah, absolutely. Because when you're looking at deals, you don't know what the appreciation is.
You have no idea. Yeah.
You can guesstimate what the mortgage paydown will be.
Yeah.
You can guesstimate that, but you can only guesstimate it because you don't know what your interest rate is going to be for the full duration. Yeah. If you're going to do a return on investment on a projection on a 5-year deal and you have a 5-year fixed mortgage, then yes, you have a fixed mortgage rate. You know exactly what your mortgage rate is going to be. You can figure out that number. But if it's a 10-year projection and you know that you have to renew your mortgage in 5 years, you don't know what that interest rate renewal rate is going to be. Mm-hmm. So you don't know, but you can guesstimate. Okay. Yeah. Additionally, you don't know what your cash flow is going to be. Yeah. Because you can guess based on what today's rent is and based on what today's expenses are, roughly what your monthly cash flow is going to be before expenses. But what happens next year when you renew your tenant and they have a different rent? And what happens the following year when the property taxes go up? And what happens the following year when the insurance goes up? And what happens in 5 years from now when your mortgage rate changes? All those numbers are going to change. They're very fluid. And you don't know what the actual net cash flow is going to be. And then you have all of your variable expenses as well. Like the roof needed to be replaced, or the dishwasher needed to be repaired, or you had 3 months worth of vacancy. You don't know what they're going to be. So it's very hard to do projections. But again, we're going to guesstimate, and I'm going to show you how to guesstimate. That way you can, if you come up with a very simple formula for how to guess it, and you keep that same formula universal for how you analyze all deals, you'll be able to compare every deal apples to apples, with the exception of the variable expenses and the variable changes, which you have no control over. But if you focus on your projections based off of actuals that you are aware of, or you determine a set number for all of them, then you can compare all of them apples to apples. But when you're trying to compare 2 deals with 2 different types of projections, with 2 different types of ways to calculate it, it's not comparable. I hope that makes sense.
Yeah, for sure.
You were going to add something, but I need to finish that note.
I was just going to go back, and this might be something that you were planning to explain, but you had when you were talking about the mortgage pay down and how if it's a 5-year term, you can determine exactly how much mortgage you're going to pay down. I just wanted to, in case there's any new listeners who are trying to understand this for the first time, you can look at a mortgage amortization calculator, which is super easy to pull up online, or even just ask your favorite AI platform.
That's exactly what I was going to get into next. Yeah.
And say, at this mortgage interest rate, and, you can plug in the details and it'll tell you exactly in 5 years, you will have paid down this amount.
A terrific segue, because that's exactly what I wanted to get into next. Perfect. Because when you are trying to determine what the ROI on a property is going to be when you are about to buy a property. So, for example, the 9 properties that I'm going to see today, there's a reason why I'm going to see those 9 properties, because they have very, very strong ROI potential. Okay. And what I do is I look at the things that I know. And like Gabby said, mortgage pay down is something that I can kind of guesstimate. What I'm going to do is, in order to determine what my profit is going to be, I know what my original investment is going to be, because I know roughly what I'm going to be putting down for that property and what my original investment total costs are going to be. What I don't know is what my profit's going to be. So I have to estimate or guesstimate, whichever, what that total profit is going to be. I like to use a 10-year time frame. It's using a 1 year time frame is like, then you're only using 1 year's worth of mortgage, and the first year in your mortgage is always like really crappy. If I could use a 20-year time frame, it would be much more accurate, but I always plan to keep a property for at least 10 years. So let's look at a 10-year time frame. That's the what I use. And again, it's all about using the same numbers, the same different is a term I'm looking for, but it's escaping me this morning. But basically comparing everything apples to apples. So if I compare all my deals 10 years, it's very universal. So what I'm going to do is I'm going to try and guess what my mortgage pay down is going to be over the next 10 years. So what I'll do is I'll take my purchase price minus my down payment, which will get me my total mortgage amount. And then I'll look at what my interest rate is right now as if I were locking it in for 5 years. And then I'm going to guess what would my mortgage rate be in 5 years from now. It's very hard to do, so I'm very conservative on that number. I think for most people, if you just chose 4.5%, even when we were in the days of 2% interest rates, I was still putting 4.5%, just to be super conservative. To make sure that I wasn't banking on all that profit. So I use 4.5% for the last 5 years of it. So what I'll do is I'll run it into a mortgage calculator, like Gabby said, figure out what would my mortgage pay down be for the first 5 years if my interest rate was 4%, and what would my mortgage pay down be for the remainder of the next 5 years after that at 4.5%. And that will tell me if I started at a $400,000 mortgage, how much do I have left owing at the end of the 10 years? That difference is what my mortgage pay down would be. So I'll figure that out. I'll write it down. Okay, cool. That's my mortgage pay down projection. Then what I'm going to do is, based off of those interest rates, I'm going to pull up my REI Masters Deal Analyzer. I'm going to figure out what is my market rent for this property
Right now,
today. Maybe with some minor increases, but to be honest with you, here's what I do. I don't ever include any rent increases in my projections because I don't know. And if you keep it that way, you'll always be happily surprised at the end, right? If you keep the rent the same for the 10 years in your projection, yeah, we know the rents are going to go up, but they might go down as well. So let's just keep it the same as what it is today. So let's say it's $2,000 rent or $3,000 rent, whatever. I'll take that minus my mortgage payment based off of right now, okay? And then minus my property taxes for right now. I'll keep it the same just for projections. Minus my insurance, keep it the same for the full 10 years. And then that will give me what my cash flow is afterwards, okay? And I will use that number, and I will use that for the first 5 years. Then I'm going to go back into my mortgage calculator again, and I'm going to change it to 4.5% when I renew in 5 years to get what my mortgage payment's going to be for the last 5 years. I know it's complicated, but once you understand it, it's very simple and quick. Then that obviously my cash flow will change for the next 5 years. And then I'll take the total of that cash flow. I'll take the total of cash flow from year 1 to year 5, take the total of cash flow from year 6 to year 10, take all that, write it down. Okay, 10 years cash flow total right here. Done. I'm not going to include any appreciation because I don't know what the appreciation is going to be. Some people like to put 3%, 4%. Why? You're over, and most people, the only reason why they do that is because they're a realtor and they're trying to overpromise to their clients, or they are an investor and they're trying to overpromise to their money partners. Both are completely fucked.
trying to get people to say yes.
You're just trying to make it look better than what it is. All I'm trying to do here is I'm not trying to impress anybody. I'm just trying to figure out roughly how much, if I use this same formula every single time and it spits out a number and it tells me that my ROI for the next 10 years is going to be 400%. And I find another deal and the projection says that it's going to be 700%. I'm going to go with the one that says 700%. Or if I find another deal that I think is really good and then the ROI for 10 years is 180%, I'm not going to do that deal because those numbers aren't high enough for me compared to the other ones. Right? So I want to keep it all universals. That way I can compare deal to deal. When someone says that, this cute little condo apartment, on Airbnb makes all this much money and everything else. Okay, let's figure out what the projected ROI is going to be for the next 10 years. And then someone comes along and says, this single family house is, it's amazing, long-term tenants and everything else, and it's a great cash flowing property. Okay, cool. What's the profitability on it? Okay, cool. I'll write down the ROI for that one. And someone comes along and says, this 97 unit apartment building, oh my God, we're going to make millions of dollars. And then I find out what the ROI is for that for the next 10 years. And I write that number down. And then I can compare the 3 properties and know which one is actually the most profitable, right? Because it's very hard to compare sometimes a condo apartment to a single family house, to a townhouse, to a suited house, to a fourplex, to a 97 unit apartment building. How do you know which one's better? Most people go super flashy and be like, hey, we just increased the rents by $25 and we can get all this money and we're going to make millions. I'm like, okay, yeah, cool. But like, what's the return on investment? Because the ROI or the investment on a 97 unit apartment building, assuming that you're going to pay $200,000 per unit, it's a $19.4 million property. If you're putting 20% down, that means you're putting $3,880,000 into that property, right? How much money am I getting back for my $3,880,000? I want to figure out what that ROI percentage is. So I know, so I can compare it to the $130,000 condo apartment that I'm going to be Airbnb-ing to determine which one is actually getting more money back per dollar put in. So you can answer let's compare it to a $200,000 townhouse, right? Because there'll be a lot of comparisons between, well, why would I buy a $200,000 townhouse when I could buy a $19.4 million apartment building or a 97 unit apartment building? Economies of scale, more money. I'm like, yes, but the profit needs to be relative to the money put in, right? You understand? Like, why would you, let's compare it to a 100 unit apartment building. 100 times 200,000 is $20 million. What's your down payment? 20% of that. That means you need to put $4 million in, or you can put $40,000 in on a townhouse. Most people would think that the 100 unit building would be more profitable, but how much money is coming back relative to the money that we're putting in, right? So we need to be able to figure out what the ROI percentage is. Sometimes it actually makes more sense to buy 100 townhouses individually than to buy 100 units in a multifamily building. A lot of people would argue with that, but that's because the ROI percentage is better on the smaller one. There's arguments to be made about, yeah, but it's only one mortgage. Okay, sure. It depends on value to you. How much do you value one mortgage and simplicity? Are you willing to give up tons of profit, tons of ROI percentage just for simplicity? That comes down to value for you. Yeah. For me personally, I've got systems for everything, and I can, like, for me personally, you guys know how I feel about multifamily. Like, it's not that I hate multifamily, it's that return on investment is not good enough for me on any multifamily deal I've ever seen. Because so many people are hot and horny for it because they look at like, ooh, look how big it is, but they don't look underneath the hood to see what the return on investment is. They don't realize that they're making 7% ROI every year when I'm making 40% ROI every year. I'm more willing to put a little extra work in, hire the right people, and build out the right systems in order to get better returns for myself, my family, and my investors than trying to impress people. I digress. This is how you compare properties. A condo apartment to a townhouse, to a single family house, to a duplex, to a fourplex, to a suited house, to a 100 unit building, to a 10 unit building. It's the return on investment that determines how profitable it is. This is why this metric is so incredibly important. This is how you know, should I buy this or should I buy this? When someone asked the other day, should I buy a single family house or a duplex? What's the return on investment? Tell me.
Yeah.
You have to know what the return on investment is, right? To determine which one's more profitable. Then you can take those other things into consideration, like who are my tenants? How much demand is for it? Is for these types of rentals? What's the appreciation potential? That's another thing we need to take into consideration, but we're not even there yet. We're just talking about ROI today. We haven't even talked about what's the potential for appreciation. You have to understand the trends in the real estate market to know what makes a piece of real estate go up in value. But for today, if we're just looking at apples to apples, property to property, investment to investment, the way to know which one is going to be better, which is going to get you more money back in your pocket, is to be able to carefully and properly do an analysis of what the projected return on investment is going to be. Again, so what you're going to do is you're going to total up your mortgage paydown, your cash flow. That will give you your total profit potential, and divide that by your original investment. That will tell you what your 10-year ROI is going to be. And then if you just want a yearly rough number based on rough math, divide that by 10. That will tell you what your yearly ROI is.
So Wayne, in the comments here, Stuart says, this is a good formula. You need a whiteboard and a white lab coat, Wayne.
I have a piece of paper and a pen.
That's all you need.
Sometimes I use my calculator. I've always had trouble with dividing bigger
smaller numbers by bigger
smaller numbers by bigger numbers. I've always had trouble with that for some reason. I don't know why. I think I was sick that week in school. You think I would be able to figure that out by now? It's like long division. I was sick, or I skipped school. I was sick for long division. I never learned how to do long division. This is a big problem in our house right now because my daughter's learning how to do long division. She knows how to do it.
She's already learned.
And I don't, and she's trying to teach me. I missed it. And I think I missed how to do that as well. I must have been sick for the whole year in division because I never got division. I mean, I can do it, like simple, but anyways, so that I always use ChatGPT or I use Google for it. It's just or some sort of a calculator because I can't wrap my head around it. And I just learned that even though I know I'm right, I still double check it every single time. That's why I did it.
Yes. Yeah.
But regardless, it's not very difficult. It's profit divided by original investment.
Yeah. So there's a question in the chat also. Francis asks, what is the minimum ROI you are looking for to have on a deal?
That is a question that I never, ever answer.
Mm-hmm. Very common question, though.
And I can answer it because I do have a number.
Mm.
Here's why
I don't even know the answer to this.
Here's why I don't answer it. It's because it is relative to the investments the returns that I've gotten in the past, and relative to the investments I can get right now. But if you ask me in 10 years, I have a feeling that my minimum threshold, my minimum, is going to be lower. Because the returns that I've gotten for the last 15 or so years, and the returns that I'm getting right now, the returns I'm getting are the best returns that I've ever gotten. And I think the best returns that I could ever get.
So you think it's downhill from here?
Yes, with the level of safety that we have in this as well. Mm. I have never and I've studied real estate history. I've studied what other people have done over the last 20 to 30 years, and I've looked at I've done projection analysis of what they made, and I've done actuals of what they actually made, and I've just run all those numbers and I've compared different opportunities in different markets at different times since the year 2000. And I can see all these people that talk about, I've been doing this for 25 years. And I was like, yeah, but I know your actual ROI. It's shit. And I know that you also went and lost like fucking 20 properties back in 2009. And but I do all that to compare them. Like, where are we right now? Is this the best of times? Or is this average? And right now, in the last 6 years, since 2020, it has been the best of times in Canada. It has. To answer your question, Gabby, I do believe that it is all downhill from here. I don't believe that I will be able to get these. I will because I own the properties. But if I go to buy more properties in the future, starting from scratch with new financing and at a new down payment based on whatever the value is at that time, I don't think that I'll be able to get these numbers forever. The properties that I own, I will continue to get them because I finance them based off of the price that I got, permitting that I don't refinance them in the future.
Right. Those
properties will continue to get amazing returns, and those returns will just grow exponentially over time because of the fact that rents will continue to go up and more will be paid down mortgage. The more will be paid down on the mortgage, again, so long as I don't refinance those properties.
Okay. So the moral of that story is...
The moral of the story is
get
that
in now.
It's a tough question to answer. And here's the other thing. Who asked it? Francis, assume you're in my position and you educate people. You are a real estate investing educator. You're a coach. And your student asked that question and I answered it. But then, you know, in 3 to 5 years from now, they're trying to find deals and they can't find deals that meet that minimum ROI. I'm suddenly going to look like a shitty fucking coach because I can't help them find it. Well, you're supposed to help me find these deals that meet this minimum ROI. And I'm like, I never said that. Like, you said it 5 years ago. You said this is the minimum. And I'm like, oh, the minimum's this now. Why? Because there's nothing good out there. Why? Teach me. So I'm almost like shooting myself in the foot. Also, if I tell you guys what my minimum ROI is, then you guys are going to be hopeless for the rest of your fucking life because you're never going to get those numbers. Not unless you learn from us. Because most people are not getting the numbers that I'm getting in actuals. They think that they are based off of their projections because their realtor told them that they're making this much money, or they think that because based off the numbers that they put in, based off of rent increases and property increases of 4.5% per year and rent going up 3% per year. And most people they're not conservative in their numbers. They think that they're getting it, but in all actuality, when they go to sell their property, all the things that they didn't consider and all that they didn't understand about market values, real estate values, and how much they're actually going to go up, nobody's ever going to tell you when they sell it in 10 or 15 years how much they actually made per year.
Right.
I know because I have the data and I can look at my portfolio and I know how much I've made. And I also know how to understand real estate trends to know how much values are going to increase. So if I say a number, you're going to try and get that number and you're not going to be able to get that number.
Okay. Let me help.
Do you want me to answer the question?
Are you going to answer it? You just said you're not.
I think I will.
Well, let me help Francis out here. Instead of what's the minimum ROI that you're looking to have on a deal, Wayne Hillier.
Yeah.
Is there an amount of ROI that you would consider good or sufficient? Not necessarily what's your threshold. What are you looking for? What do you expect? What are you actualizing? But is there kind of like a minimum that's like, hey, that's pretty good. That's decent.
I'll answer it. I think that everyone should be striving based off of the calculations that I gave today, not including any rent increases, not including any appreciation. This is just mortgage pay down and cash flow. Okay. That's it. Mortgage pay down and cash flow. And the way that I calculate it, I think that everyone should be striving for a minimum 15% ROI.
Yearly.
So over 5 years, it would be 75. Is that right? Yeah, 75%.
Okay.
Over 10 years, you should be looking for 150% ROI minimum just off of mortgage pay down and cash flow. That, in my opinion, would be the minimum that it would be worth it to run this business. Because then, it's a very long answer, but then anything less, I would argue that you could get returns like that somewhere else that didn't require nearly as much work. But it would come with more risk. Right. There's a lot more fluidity to those returns. It'd be like 7% one year, 20% next year, 5% the next year. It's not like a set number like in real estate investing because it's mortgage pay down and cash flow.
Right.
But there's a strong argument that can be made that anything less than 15%, you're almost better off putting it in something else and getting a 10% return and then not having to do all the fucking work that we have to deal with.
Right.
There's a strong argument to be made. And lots of people are like, why would I invest in real estate? I got to deal with all this shit. I completely agree with you. You are trading your time for it as well. So my belief is that a minimum of 15% ROI per year is needed in order to commit yourself to this passive job. What do I aim for? My number is 20%. I want to make sure that my money doubles every 5 years, minimum, on just mortgage pay down and cash flow.
So 20 per year, you said double in 5 years. That's 20, 40, 60, 80, 100.
Yes.
That's how that math works.
100% ROI in 5 years.
Yeah.
Because I want my money to double every 5 years just on mortgage pay down cash flow. And you guys have heard me say this before that I want to make sure that this deal is profitable regardless of appreciation. And that is the minimum profit that I want to see. Now, I don't know if the roof needs to be replaced. I mean, I do, because that's other layers of diligence that I would do. And this is why I say this is just one thing that I look at when I'm analyzing deals. One thing. I am taking into consideration what the age of the roof is and how long I'm holding the property. There's tons of other things I'm taking into consideration. I am taking into consideration condo fee increases. I am taking like so much more. Yeah. It's very, very, very technical and very calculated. But for just simplicity for you guys, if you're not joining our mentorship program and you're not learning everything that I teach and learning that advanced level of real estate investing and scaling, then this is what you need in order to function as a basic real estate investor. That's the number. But I want to make sure that it doubles every 5 years. And again, that does not include vacancies. That does not include repairs. That does not include flooring replacements and all those other things. Those are all things that we factor in. Those are all expenses that I will have to take into consideration that will actually, that will tweak my actual numbers. Right. My actuals are going to be different afterwards, but my actual numbers at the very end will also include rent increases. So my cash flow will go up over time. It will also include appreciation, which I'm going to be buying properties with tremendous potential for appreciation. So most of my profit's going to be in appreciation, right? And then there will be deductions of expenses, but I don't know those things. Yeah. Those are the things that I have no control over. So I focus on the things that I do have control over, and that is mortgage pay down and cash flow. This is why I tell people don't add appreciation or don't add rent increases in there. Why are you adding in things you have no control over?
Make sure it's good without it.
Make sure it's good without it. Then you can compare properties apples to apples, right?
Without speculation.
Without speculation. I hope that makes sense. And I hope that helps you guys have a better understanding of how to know.
I think this is great.
Yes?
I think this is fantastic.
Okay. Sorry.
You okay?
I was just trying to look at something here.
Okay. There is one final question that I'd like to answer.
That's how you know, sorry, I lost my train of thought, but that's how you know if you have a good real estate deal to start. These 9 properties that I'm going to look at today are all minimum 20% ROI on just mortgage pay down and cash flow. Now, don't hold me to that number, because in the future, that number might change. My number might be dropped down to 15% because I can't get 20% deals anymore. And I'm telling you right now, there was a moment in 2023, 2024, where I was like, I can't get anything like that anymore. But then opportunities presented itself, and that's why I'm buying like crazy. Because if you can get these numbers, and you can get them, for this period of time, and I know that window's only going to be open for a small window, a small bit of time, then
start the car.
Let's go. Let's buy as many as we can before that window closes, and then there'll be years where I can't buy properties that meet that minimum criteria for me. Is the question relative to?
Yep.
Okay.
And it should be quick and easy to answer. Mayatoma asks, you mentioned in previous podcasts, but I can't find it because this was a long time ago. I know what you're talking about. The old-fashioned mortgage calculator that you guys used. Any hints?
Oh, it's gone now.
Yeah. Irrelevant.
Yeah. And so use AI. You can use Google now.
Yep.
For God's sake, Google's got Gemini built right into it.
Yeah.
So Gemini can give you a mortgage calculator as well. What I use for quick and easy is we have a REI Masters deal analyzer, which calculates all the numbers that you need. And it also has a built-in mortgage calculator as well. So you'll type in your interest rate, you'll type in your amortization and your mortgage amount, and it will give you a full mortgage amortization schedule, which you can see how much you pay down every month and what. So I can literally go down like 10 years and see what's my balance going to be and how much have I paid down, how much interest have I paid. And then the mortgage buy down actually gets transferred over into the other side where it shows me 5 years how much mortgage pay down do I have, 10 years how much mortgage. So it calculates the ROI for us.
Yeah.
It takes the total cash flow, it takes the total mortgage pay down, and then I can add in appreciation as well. If I want to get actuals, I can type the appreciation in there, what my actual appreciation was, or for projections, I can put in 1%, 2%, 3% per year if I wanted to know, hey, if this property did go up 3% per year, what would my ROI be? So we have a really good deal analyzer. It's very super simple. And I know there's a lot of deal analyzers out there. They like
super
are
complicated,
way too overcomplicated. They try and make themselves seem smarter. I'm all about simplicity. I want to put my numbers in. I want to get the numbers that I need back. I don't need everything else. I don't need, like most of them are based off of projections and shit like that, which you don't need.
Yeah.
Right? You should be focusing on what do I know for sure, right? Not based off of like, well, if it goes up 5% per year, then I could be making a 200% per term per year. I'm like, yeah, if it did, but you don't know that.
Mm-hmm.
It's better to under-promise and over-deliver.
Mm-hmm.
Okay? That wraps up today's show, guys. I hope it's valuable. I hope it helps you guys have a better understanding of how to know if you have a good real estate deal. Stay tuned to the show, please. Stay tuned every week. I didn't talk about any of the other stuff, but I do talk about this stuff on a regular basis. And we will have other shows where we'll talk a little bit more about appreciation. We will have talk a little bit more about vacancies and how to predict vacancies or how to prevent vacancies. Because if you can prevent people moving out and turnover in your rental properties, then you can actually save tens of thousands of dollars over the duration of owning a property, right? And we talk about all this stuff. We teach you about how to put the right systems in place in order to make sure that you prevent that, to get you the most profit, to get you the best return on investment. That's what we're trying to do here, to make you the most amount of money for the money that you're putting in. We'll see you guys all on Monday.
No, we won't. It's a holiday.
We'll see you guys all on Tuesday.
Thanks for listening. Want to be coached personally by Wayne and Gabby? Then you should join the Real Estate Investing Masters Mentorship Program. Details are in the show notes to get started.